Welcome to The Explainer. Today, we're going to try and unravel a bit of a market mystery.
All right, let's get right into it. On the surface, everything looked great. I mean, here's a 3D printing company, Stratasys, that seems to be doing everything right. But the market's reaction? Yeah, that tells a completely different story. So, the company holds its earnings call, right before the market opens. And at first glance, the results, they seem to check all the right boxes. Seriously, this is the kind of report you'd normally expect to send a stock higher. First up, revenue. They brought in $138.1 million for the quarter. That's a little bit better than what the analysts were predicting. So check one, that's a win. Then you've got earnings per share, a super important profitability number. It landed right at 3 cents, which was exactly what everyone expected. So check two. So far, so good, right? Everything's looking rosy.
But, and this is a big but, the market's reaction was just brutal. And it was immediate. We're talking before the opening bell even rang, the stock just cratered, down 15%. This wasn't just a little dip, This was full-on investor panic.
So you've got to ask, what happened? This huge disconnect, it points to something lurking deeper in that report, something that really spooked investors. It's a classic case of the devil being in the details. And when it comes to earnings reports, those devilish details are almost always found in one place: the guidance for the future.
And that's where we get to the real heart of the matter here. See, it wasn't about the quarter that just finished. Nope. It was all about what's coming up for the rest of the year. For investors, looking back is interesting, sure. But the future? Well, that's where the money is made or lost.
Okay, so here it is, the smoking gun. Management slashed their financial guidance for the whole year. Now, you're seeing the new numbers here, but the key thing to understand is that this was a massive cut from what they'd said before. We're not talking about little tweaks here and there. This was a significant chop to everything: revenue, profits, the whole shebang. And their explanation for this? Well, they said these huge customer deals, the ones that really move the needle for the company, they were just taking a lot longer to get signed. And why? Because of all the uncertainty in the economy. Big companies were getting cautious and tightening their belts. But Stratasys management, they had a totally different take on all this. They basically said the market was completely overreacting. So let's flip over to their side of the story and see how they tried to calm everyone down. So the CEO, Dr. Yoav Zif, he got on the call and was absolutely adamant. He drew a really clear line in the sand. He said, look, this is not a slowdown, it's a delay. He's basically arguing this isn't a demand problem, it's a timing problem. The deals are still there, they've just been pushed down the road a bit. And this really gets to the core of it, right? You've got these two competing stories. On one hand, you have the market's fear that customers are just canceling orders, that the business is disappearing. And on the other hand, you have the companies saying, no, these big deals are just deferred, they'll happen in 2026. And honestly, the entire investment case for this company hangs on which of those two stories you believe. Now, to back up their story, management pointed to their finances. They argued, hey, we've got the financial muscle to wait this out. They've got a really strong balance sheet. We're talking over $254 million in cash, 0 debt, and they just got a $120 million strategic investment. Their point was pretty clear. We can afford to be patient and wait for these deals to come through. So moving past all the drama about the short-term guidance, the company really tried to shift the focus. They started highlighting all these key strategic moves they're making. The goal was to show investors that, yeah, the timing of a few deals might be off, but they are absolutely still building a strong company for the long haul. And they had some pretty big names to back that up. I mean, they're pointing to major partnerships and wins with companies like General Motors, Toyota, even Blue Origin for aerospace stuff. These aren't small-time customers, right? These are industry titans, and they're using Stratasys technology for real, serious production work. That's a huge vote of confidence. And this quote here from NASCAR's Team Murphy, it really drives that point home. They're saying that Stratasys isn't just a side project for them. They've literally transformed 3D printing into a strategic business unit. That means it's a core part of their operations, something they're counting on to make them more competitive. They also made it super clear they're not just sitting around waiting. They're pushing hard on the innovation front. They've been acquiring technology from other companies and launching all sorts of new products, from new materials like this P3 silicone to new software. They're actively growing what they can do. Okay, so you've got this whole picture now, right? The ugly guidance cut, the CEO's passionate defense, and all these cool long-term projects. So the big question is, how does Stratasys actually plan to win back investor confidence? Because, words are one thing, but the market wants proof. And they know that. So they basically staked their credibility on one very specific, very measurable target for the end of the year. It's their way of saying, all right, don't just listen to us talk, watch what we actually do, judge us on this.
And here's the promise. They committed to hitting an adjusted EBITDA margin of 8% or higher in the fourth quarter. Now, that's a key profitability number. But here's the kicker. They said they'd do it regardless of how much revenue they bring in. That puts all the focus on their ability to manage costs and just run the business super efficiently.
Nailing this target is everything for them right now. It's about way more than just a number on a spreadsheet. It's about proving that their cost controls really work and that the business itself is fundamentally healthy, even when the economy is tough. It's their big play to shift the whole narrative from defense to offense.
And that really leaves us with the million-dollar question, doesn't it? You have this big battle, the company's long-term vision versus the market's short-term fear. Can hitting one single profitability target in Q4 be enough to convince everyone that the long-term plan is solid and can overcome these fears? Well, that's exactly what investors are going to be watching for.